This is the second video in our Chapter 10 videos. So we're going to talk about preferred stock now. Sometimes I want to raise some cash, but I don't really feel like giving away a piece of my company. But I don't really feel like going out and borrowing the money in the bond market or at the bank because I'm worried about my ability to repay it and to pay interest. So in that case, I do something called preferred stock. Now, preferred stock is its own class of stock that sits in the equity section of the balance sheet. It's a little less risky for investors than common stock because, again, if the company goes bankrupt, the bondholders are going to get paid first, then the preferred stockholders, and then lastly, the common stock. So it's got a little bit less risk. Usually it doesn't have a lot of voting rights. So if I'm the company, I'm the one issuing the stock, I like that. I don't have as many people in my business. But the benefit, the reason the preferred shareholders like to do it, is usually it has a fixed dividend. Now, by fixed, what it means is dividends tend to work for common stock in that the company looks at its earnings, it looks at its cash, and it decides what kind of dividend it can give. It can be $0, it can be $100, it can be $1,000, or anything else. With preferred stock, there's some sort of negotiated dividend that the preferred stockholders are entitled to. I'm putting a big star by this, if the company pays a dividend at all. All right, so the company can still choose not to pay a dividend, but if they pay it, they have to pay those preferred shareholders first, and it has to be at that stated rate. So if we look at the different comparisons, let's just pull this whole grid up. Oops. So you can see it. I want to raise cash for my company. I can issue common stock. I can issue preferred stock, or I could issue a bond. So again, you can see the different elements of it. Voting rights, right? Common stock, yes, people are going to be in my business. They're going to have a vote. Bonds, they don't. But preference for dividends and interest, right? So the bonds, I'm going to have to pay them interest, right? The common stock, I don't have to pay a dividend. You can see from an investor standpoint, common stock is going to be the riskiest, and bonds are going to be the lowest. So there's a lot of different pieces that go into that. CFOs and treasurers, these are some of the choices they make when they've got to go out and raise money. So preferred stock can have a whole host of different attributes associated with them, and we're only going to touch on a couple. First is convertible. That means my shares can be exchanged for common stock. Sometimes that's a benefit. So sometimes people attach a convertible option to a preferred stock issuance. Redeemable. This means that the corporation could purchase the stock back from the shareholder. But the one we're going to spend time on is this concept of cumulative. And what it means is, again, if the company pays a dividend, the preferred shareholders get made whole first. So let's talk about what that means. What that means is that if there are years that I don't pay a dividend, I still owe those preferred shareholders that money. Right, so let's assume that a company issues 1,000 shares of 8%, $30 par value preferred stock. All right, so right now we know that the preferred shareholders are entitled to an 8% dividend, right, for the amount of shares that they hold, whereas the common shareholders aren't really entitled to anything. So if the company declares a dividend in 2018, right, but they didn't do anything in 2016 and 17, the concept I want you to understand is they have to catch up those preferred shareholders and pay them first before anybody else can get paid. So I'm going to pay what's called in arrears, right? So let's figure out how much we owe them every year. For the preferred shareholders, we issued 1,000 shares at a $30 par value, right? And that's how much cash we got. So we got in $30,000, and we promised them an 8% dividend, which is $2,400. All right, since I didn't pay anything in 2016 and 17, I owe that to them. Then I also owe them the 2018. Well, now if I have any money left over for the amount of dividends I decided to pay, because I wanted to pay out $10,000, oh good, I have $2,800 left over. That can go to the common shareholders. If it had been non-cumulative, then I don't have to do this piece. I don't have to catch up those preferred shareholders for past years, but I do have to pay them for the current year before I can pay my common shareholders. right? So if you're a common shareholder, you're hoping if the company issues preferred stock that it's not cumulative, because you can see being last in line, I get more if they don't have to catch up for past years than I got if we do. All right, so I want you guys to try this exercise and try to determine how much will be paid in dividends in year 2. Okay, we've got 1,000 shares of 6%, $100 par value preferred stock. What I usually do first at this point is I just figure out, okay, what's that dividend per year? So I do the 1,000 shares times the $100. Right, so when I issued it, I got in $100,000. And then I multiply that by the 6%. Right, so that says I owe everybody $6,000 a year. Year 1, company didn't pay any dividends. Oops, but it is cumulative, so I'm still going to owe it to people. Okay, so my preferred dividend in arrears for year 1 is $6,000. Okay, but I know my total is 14. I still owe them the year 2 amount as well. How much is left over for common? Well, it's $2,000. All right, now if it's not cumulative, I still have to pay them the year 2 amount of $6,000. How much is left over for common shareholders? Well, it's $8,000. All right, let's do one more exercise. This one's a little bit more holistic about everything we've covered so far in Chapter 10. So record each of these transactions and we'll look at it together. All right, so first we've issued 10,000 shares of no par common stock for $20 per share. We got cash in of $200,000. I'm going to debit cash. I'm going to credit common stock. Since it didn't have a par value, I don't have to split the credit portion of that entry between paid-in capital and common stock. Now on May 15th, I issued some preferred shares. I issued 1,000 shares at $11 par, because par is a little more meaningful in preferred stock. So I issued $11,000 in preferred shares. So I'm going to debit cash for $11,000. I'm going to credit preferred stock for $10,000 and additional paid-in capital for $1,000. Where did that $1,000 come from? The difference between the par and how much they paid me, just like common stock. All right, now it's time, let me erase this. All right, now it's time for me to actually pay a dividend. I say I'm going to pay a cash dividend of 50 cents per share to all stockholders of record, both common and preferred. Okay, so, oops. This happened last time. All right, so I've got 11,000 shares, 10,000 shares of common, 1,000 shares of preferred, times 50 cents. I'm going to pay a cash dividend of $5,500. Debit dividends, credit dividends payable. So stop for a second, think about that. Where's that dividend account sit? Hopefully you remember that it sits in equity. It's a contra equity account, right? Because remember, income helps grow my equity, dividends help shrink it. All right, and then the date of record when I actually pay them, or the date of record is the date that my people that work in the back office that pay the shareholders, they look to say, okay, on October 15th, who owned shares? We don't make an entry on that date. But we do go ahead and make our last entry when we pay it, because remember, before we accrued a payable, now we release the payable and decrease our cash. All right, so let's start talking about treasury stock, because again, this is this funky thing where we own ourselves. So there's a couple different reasons why companies might go out and purchase their own stock. You haven't learned about earnings per share yet, but what earnings per share is it's net income divided by the shares outstanding. Well, that number is used a lot in the marketplace to indicate how well a company's doing. Well, if I can decrease the number of shares outstanding, my denominator, I've now increased my earnings per share, right, by decreasing the number of shares. So companies might buy back their own stock to make their earnings per share look better. They might also do it just to boost their underpriced stock. They think it's a good investment, so they're trying to decrease the supply out there. Remember, supply versus demand. If they decrease it, perhaps the price will go up. So when I purchase my own treasury stock, there's a couple pieces that are important. First one is how much I pay for it. So Canadian Falcon repurchases 100 shares of its own penny par value stock at $30 per share. I'm going to debit treasury stock and credit cash. Now, where does this treasury stock account sit? It is a contra equity, just like dividends. So it's going to sit in the equity section. It's not an asset. So I want you to put a star by this, not an asset. It is contra equity. This is what it would look like in the balance sheet. Before I repurchase those shares, right, I just have the 100,000 in stockholders' equity outstanding. After I repurchase them, instead of decreasing my stock accounts, I'm showing the decrease in this contra equity account called treasury stock. And you can see total equity decreased by the $3,000. Okay, but now let's just say the tides have turned, I want to reissue some of it. So if I reissue it for more than I paid for it, I'm going to do one entry. I'm going to debit cash for how much I received when I sell it. I'm going to take it out of treasury stock at the amount that I paid for it. And any difference will go to additional paid-in capital. Why is that important? Well, let's put a T account up and think about it. When I repurchased these shares, I repurchased them at $30, and I had in the treasury stock account a $3,000 debit. If I put that whole $3,500 I got in, I'd end up with this weird $500 credit in a contra equity. That doesn't make sense. So I've got to only take out what I put in, right? So that's down to zero. That's why I balance the entry with additional paid-in capital. And again, the before, I've got my treasury shares outstanding. Well, now I have sold my treasury shares, my treasury stock account at zero, and that additional cash I got increased my additional paid-in capital. Okay, but let's contrast that with what if I sold it for below, right? So I had initially repurchased those shares for $30. Now I'm selling them again, but I'm selling them for $25. So I'm going to debit cash for the $2,500. I'm still going to credit treasury stock for what I paid to get them in, and I balance the difference with APIC. So what I want you to take away from this is that, right, whatever money I put into the treasury stock is what I pull out when I sell it. And I take any difference to that additional paid-in capital, whether it's higher or lower. All right, so let's do a quick concept check. Treasury stock has a normal what? Pick one of these. All right, hopefully you picked B, decreases stockholders' equity because it's a contra. Oops. Okay, let's go ahead. I want you to work this problem, and then we'll come back, look at it together. All right, so we've got 10,000 shares of common stock for $20 per share with $1 par. Whoops. Okay, we see par right away. We know we're going to have to break up the credit between common stock and additional paid-in capital. We got $200,000 in, so we debit cash. We're going to credit common stock just for that par value, 10,000 shares times the $1, and balance the entry with additional paid-in capital. Now I've issued 1,000 shares of 6% preferred stock for $13 per share, and it has a $10 par value. Again, I see there's a difference between par and what I got, so I know I'm going to have to break up the credit part of the entry. So I get cash of 13,000 in. I have preferred stock. The par value is $10 per share, so that's going to be 10,000. And I balance the entry with additional paid-in capital. I'm being overtly simple when I say this, but you can almost think about with equity transactions, when in doubt and trying to balance your entry, use additional paid-in capital. If you're just guessing, it's probably going to be right a lot of the time. Okay, so now I've purchased 2,000 shares of my own common stock for $40 per share. Okay, I've got treasury stock now. So with the treasury stock, when I purchase it, I don't deal with additional paid-in capital. I just simply debit the treasury stock, credit cash. But now I resell $1,000 of it at $50 per share. So remember, I only take out of treasury stock what I put in. Well, I had purchased treasury stock at $40 per share. So I'm only going to take that amount out, and the difference is going to go to additional paid-in capital. So remember, buying treasury stock, I don't deal with paid-in capital. Selling it, I deal with paid-in capital if the amount is higher or lower than what I bought it for. Okay, I'm going to pause there, come back, and we'll just wrap this up.